Good morning. You are watching a live daily market outlook for Monday, 30th of April 2012, prepared by Windsor Brokers. We are at the beginning of the new week and the end of month of April, as today is the last day of the month, with the main focus now on US dollar that continues to trend lower and actually hit fresh 2-month low versus the yen and 8-month through against sterling this morning, earlier today, staying under pressure after data released last week showed disappointing first quarter U.S. economic growth. The dollar so far this morning tested the zone at 80.00 Fibonacci support and the round figure support against dollar yen, while a single currency continues to head higher with some consolidation seen during the Asian session after hitting a fresh month high at 132.69 last Friday. Cable also remains well supported against the greenback with the 162.90 high seen this morning, just ahead of 163. Our next barrier with the strong bullish tone seen on the lower time frames, keeping the focus at the upside. Dollar against Swiss is in the downtrend of recent peak at 92.50 with the loss of 91 support last week, keeping the pressure on the downside. Recovery seen on the commodities prices as the crude oil regains ground again and heads at over $105 per barrel, as well as gold that bounced higher after a brief consolidation at levels around the 2040 zone. Now it's back to 1660, looking for a further extension higher and test of our next target at 1686. More of this we will have in our technical part. As said, disappointing data from US are now keeping the outlook about US growth more grim, as the growth in the United States is softening, and as well as slump in Europe deepening, and also the UK Britain has fallen back into recession, heightening concerns that efforts to cut budget gaps could go too far. The fiscal austerity has been the mantra on both sides of the Atlantic for the past 2 years. The tide now appears to be turning. In Europe, socialist François Hollande, who is favored to win the runoff election for the French presidency on Sunday, has laid out a growth agenda. Italian Prime Minister Mario Monti, after pushing through tough budget reforms, is calling on the European Union to back a growth plan. European Central Bank President Mario Draghi, who wants a growth compact for Europe to complement its fiscal compact, an issue he is likely to be quizzed on at this monthly news conference on Thursday. Even Germany, the fast losing allies for its harsh fiscal medicine after the Dutch government fell over budget cuts, is modifying its tone. We are not the fiscal consolidation Taliban. German Deputy Finance Minister Thomas Steffen said at a conference last week. In the United States, there are tentative signs the fiscal debate is poised for recalibration. Comments from Republican member last week saying harsh austerity was all the rage, and it drove the U.S. political and the U.S. growth. Pardon, it drove the U.S. growth now again into slowing mode. Analysts point to U.S. Senate Republican leader Mitch McConnell's decision to withhold his support for the tough budget adopted by the Republican-controlled House, which would deepen domestic spend cuts beyond the levels agreed on tortuous deficit talks last August. A new poll hints at a waning of support for the Tea Party, the driving force behind the deep budget cuts. An ABC news. Washington Post poll on April 15 found that Americans by a broad 23-point margin say the more they hear about the Tea Party, the less they like it. Its support has slipped to 41% of Americans from 47% in the last September. From the Fed Reserve Chairman Ben Bernanke last week issued his sternest warning yet over the risks of sharp fiscal contraction. Numerous tax cuts are due to expire, and budget cuts will kick in the year end, enough to withdraw $500 billion from the economy. Analysts say that would cut 3 to 5% points from growth and tip the economy back into recession. So I would say not good news coming from whole world, and the biggest economies will be, of course, following closely this development in the world economies and the updates. We're going to take a look now at today's calendar and see, as Japan and China are out of play for today due to the market, the rest of the world is still on and working, and the early release during the overnight private sector credit for March in Australia came at slightly better than expected. 0.4 is release for today compared to a slightly lower forecast at 0.3 and the 0.4 of the previous release of month of February. German retail sales came as expected at 0.8 compared to February's release at minus 0.9%. That shows the recovery of the monthly retail sales in Germany. Still to come at 8 o'clock GMT, Eurozone private loans for March expected to increase to 0.9% compared to 0.7%, while March M3 money supply is expected to stay unchanged at 2.8%. More important is Eurozone flash estimate for the inflation for the month of April, with decrease to 2.5% forecasted for today versus 2.7% of March release. Across the ocean starts with the Canadian monthly GDP for February. That is forecasted at 0.2%, slight increase from 0.1% of the January's release. RMPI from Canada also improvement at 0.5% today's forecast compared to minus 0.5 of previous month, and the Canadian IPPI for March is expected at 0.3% compared to 0.2% of the release of February. From America, core PCI price index for March, slight decrease, forecast at 0.2% is today's consensus compared to 0.3% of the previous month. U.S. personal spending is also expected to decrease in March with 0.5% seen for today compared to 0.8% of February. U.S. personal income is forecasted for a slight increase by 0.3% compared to 0.2% of release of month of February. And finally, at 13:45 GMT, Chicago PMI for April, slightly lower from the previous 62.2% release, is 61%, pardon, for today. And that was all for today's economic indicators. We are going to take a look now on the markets and see the latest movements in the major currencies and the commodities. The euro, as said, maintains the positive short-term tone of 129.93 recent low, as the last Friday's action after dipping down to 131.57, where the good support was found. That also marks Fibonacci 38.2% of the entire move, extended the gains on the sharp rally to fresh 1 month high at 132.69. Overnight's price action was seen moving within the very narrow range and hovering around 132 50 zone. Positive studies are still dominating in the lower time frames, as 1 and 4 hour chart studies are still holding up. However, some loss of momentum is seen on the hourlies, with possible corrective action seen preceding a fresh rally. Immediate support overnight low at 132.29 ahead of 132.00 as previous high and the round figure support, while only loss of last Friday's high at 131.57, that also marks Fibonacci support, would delay immediate bulls in favor of stronger correction. On the downside, key support remains at 131.00, that also marks 61.8% Fibonacci retracement, and basically only loss of this level would confirm the lower top at 132.69 and refocus 130.00 as very strong support area. Situation on daily chart shows improvement as the MACD is now breaking above its midline, and the pair holds steady above 132.03, that is 55 days moving average, keeping the focus at the upside. Clearance of 133.00 as round figure resistance and psychological barrier would open way for next very significant resistance at 133.80 zone. These are the levels of end of March, beginning of April, where the pair left a double top ahead of recent slide down to that tested 130.00, a very strong support zone. As long as this area stays intact, and this actually marks past 2.5 months range floor, slightly turn the higher focus will keep upside targets in play, 130.00 and 133.80. On the larger picture, only loss of 130.00 and 129.50, that marks Fibonacci support, would be quite negative, and would likely focus a yearly low at 126.22 in the short term. As said in the introduction, the cable remains in a strong uptrend after clearing a 162 barrier. That was the last stronger level, with sharp rally seen after breaking above 162, extending last Friday to 160, actually this morning to 162.95, just a few ticks ahead of our next strong barrier and psychological resistance at 163.00. Positive tone continues to drive the pair higher. However, quite extended the conditions of the short-term studies on 1 and 4 hour charts and the RSI deep in the overbought zone see potential of corrective action preceding a fresh rally, with the RSI already emerging out of the overbought zone on the hourly chart. That might signal, I know studies started pointing lower, that might signal some corrective action ahead of a fresh push higher. Immediate support at 162.63 and 162.50, where is also the 20 days hourly exponential moving average ahead of more significant 162 zone, the previous high of 26th of April, as well as 55 days exponential moving average, and basically only loss of 162 and 161.50 would delay the immediate bullish structure and open way for a stronger correction. A key support on the short term remains at 160.75-80 zone. That also marks approximately between 38.2 and 50% retracement of the entire move from 158.17 to 162.95, and only loss of this zone would have bigger impact on the pair's current structure and would put bulls on hold in favor of a deeper reversal. Loss of 160.00 is to refocus 158, very strong support on the larger charts as shown on the daily. Above this we have 158.40, the 200 days moving average, and the higher platform at 158.00. As said, only loss of 160.00 would turn the current tone negative, as the pair is now in the strong rally after breaking above 2 months range that was defined by 160, 61 and 156 zone, moving from beginning of February until mid-April when the pair broke higher. The dollar yen continues its short-term weakness after brief consolidation and corrective action of 80.28 low of 16th of April was capped by descending trend line of 84.08 peak, initially at 81.77 and the lower rejections at 81.68 and the last one at 81.43. Loss of supports at 80.65 and more significant 80.28 is now testing our next strong support at 80.00 zone. We have 80.09 that has been tested so far, 50% retracement, and around figure support 80.00 low of 28th of February 2012. Negative tone on the daily chart, looks for an extension below 80.00 to test initially 79.69. that is what is currently 55 days, 90 days moving average, ahead of post-intervention peak of end of October 2011 at 79.52. On the lower time frames, negative studies are dominating, but overstretched studies see potential of corrective action, yet no clear signal on the hourly chart for any bounce higher. That will be so far seen corrective as long as 81.00 minimum, 81.00 holds the upside. 80.85 we have the recent low, and the 81.05 55 days exponential moving average, and these levels are expected for now to cap the upside. Only break above 81.00 would provide the temporary relief for the pair and allow for stronger correction higher. Dollar Swiss also remains under pressure as the latest reversal and the slide of 92.50 peak of 16th of April 2012 lost some significant supports at 91.00, 90.90 and 90.84, currently testing the triangle support on the daily chart at 90.50. that was the low seen so far. The daily situation studies are now breaking below their midlines and keep the downside firmly in focus as the pair broke below 55 days moving average at 91.20. Break below the strong support at 90.50 that marks the triangle support will open way towards the next very significant level at 90.00 low of 2nd of April 2012, ahead of more significant and strong support, double bottom of end of March at 89.30, where is currently also the 200 days moving average, and a break of these levels would allow for a more significant weakness of the pair as it continues to decline from the beginning of the year peak at 95.93 with the 89.30 seen so far, followed by current corrective action from 89.30 that peaked at 93.30. As said, negative tone persists on the hourly studies as well as on the daily studies as well as hourly and 4-hour, with the near-term studies seen currently in the sideways mode after hitting 90.50 low, with some correction not ruled out at this point. Only break above 91.30 last Friday's peak as well as trendline resistance would provide a near-term relief and allow for some stronger action higher. Otherwise, firm focus remains on the downside with the loss of 90.50 to open 90.00 and more significant 89.30 low. And a quick look at yellow metal that again regained strength after larger picture shows the dips were more or less contained by the main bull trend line drawn of 1522 through the next low at 1612. Some dips lower were seen to 1623 and 1624, but overall the pair managed to bounce higher and regain our next trend line resistance of 1725 high that is currently standing at 1668 and been tested so far. Immediately above this level we have 1675, the 90 days moving average, and the static resistance at 1680, high of 12th of April 2012. More significant resistance zone lies at 1700, where we have a 1697 peak of 27th of March, as well as 200 days moving average, and basically break above these levels is required to confirm the higher lows at 1612 and 1623 and allow for a stronger recovery towards initial barriers at 1612 and 1712 and 1725. And finally, a quick look at the crude oil. Hourly structure remains positive after finding support at 103.73 on last Friday, with the fresh action higher, with the fears of investors on the current grim outlook from U.S. economy, as the latest disappointing GDP data released last Friday keep the pressure on the dollar and lifting its counterparts gold and crude oil higher. The pair currently reached this morning 105.02. That's the high of the session and the day so far. More significant is the attempt through the trend line resistance, the main bear trend line drawn of 110.53 peak. That will allow for a stronger recovery. This also marks slightly above 50% retracement of the entire down move from 110.50 down to 100.67, with the next significant static barriers at 105.45.48 and 105.62. Fibonacci 61.8% break of this congestion would allow for a stronger rally of the oil and open next significant level at 108.68. That is the high of 107.70 and 108.68, high of 19th of March 2012. On the lower time frames, a positive tone dominates and drives still the oil price higher, as well as 4-hour chart that maintains positive tone. So overall, a short-term tone on crude oil remains positive and keeps the upside in focus, with the next significant barriers at 105.50-60 zone, a break of which to open way for a more significant gains. On the downside, strong support and the near-term range floor at 103.70, where is also the 55 days moving average. Only loss of this level would soften the short-term tone. Thanks a lot for attending our live session. That was all for today, Monday 30th of April 2012. All those who connected later, you can find the recorded version of this session in the YouTube Windsor Brokers site calls Windsor Brokers Forex. We are back tomorrow morning at the same time at 7:00 GMT, and I wish you a nice day and very successful trading. Good luck.